From 1,000 tickers to a short list, the confluence test by value and momentum portfolio. Every week, the market gives you 1,000 reasons to buy something. An earnings beat over here, an analyst upgrade over there, a filing that shows some well-known fund building a position. And on its own, each one of those is just noise. One data point dressed up to look like a signal. So the question I keep coming back to is a different one, a narrower one, and a far more useful one. When do they line up? When does the same company show up in the same week across signals that have nothing to do with each other? A real earnings surprise. A research analyst turning more bullish. Institutions putting money to work. An insider buying with their own cash. When all of that points at one name, it stops being noise. That's what conviction looks like. One signal is a rumor. Four signals pointing at the same name. That's a thesis. Welcome back to the Value and Momentum portfolio. Today I want to walk you through something I've been calling the confluence test. Here's what I did. I took 6 data sets covering the last 7 weeks of the market. Analyst upgrades to buy rating reaffirmations, institutional purchases, large earnings surprises, big insider buys, and the full record of insider trading, and I ran them against each other. Not in isolation, the way most screens work, in sequence. In each case, I asked a simple question. When one catalyst fires, do the others follow within days? And what came back surprised me. Not because of what lined up, because of how rarely it did. One quick note before we get going. Everything here is for information only. It is not investment advice. These numbers come from screening data over a 7-week window, and like anything pulled from screens, they're worth checking against the actual filings before you act on a single one of them. All right, let's get into it. Segment 1, the perfect setup that wasn't there. Let's start with the cleanest idea in the whole playbook. A company crushes earnings, an analyst upgrades it to buy within 72 hours, and institutions are buying the stock over that same window. Earnings momentum, validated by the sell side, and funded by real money. If you've read enough market commentary, you've been told this is the setup to chase. So I looked for it, and 8 companies cleared the first 2 hurdles. They beat the estimates, and they drew an upgrade inside 3 days. Names you'd know: Dell, Snowflake, SentinelOne, Hewlett-Packard Enterprise, and 4 others. Textbook setups, all of them. Then I checked the last piece. Were institutions actually buying these names in that window? Not one of them, 0. Now, some of that is a quirk of the data, and I'll be honest about that in a few minutes. But the deeper point holds either way. A beat and an upgrade. That's the market's reaction. Institutions quietly accumulating over time. That's the market's conviction. And those two things don't always travel together. So when the headlines are loud, but the money hasn't followed, that triggers the most useful filter I know. If the market is refusing to reward something, it isn't a buy yet. It's a maybe. Segment 2. Where the smart money move first. Okay, so where did the signals actually line up? The names that passed the test all shared one thing. The insiders and the specialist funds got there first, before the research analysts caught up. Take Insperity. The chairman and chief executive bought nearly $8 million of his own company's stock. And 5 days later, an independent investment manager, somebody with no connection to him, was buying the same name. 2 parties. No coordination. Same conclusion. Or take Robinhood. A director put $35 million to work across 2 purchases. Institutions followed, and analysts spent the next week raising their price targets. That's the rare case where every single signal pulled in the same direction. But the one I found most instructive was Boston Scientific. Here's what happened. An analyst cut their price target by about a quarter, and they kept the buy rating. And in that same window, 2 different institutions bought the stock into that markdown. Think about what that is. That's conviction expressed through weakness. The people closest to the name are adding while the target is coming down. That's the opposite of chasing, and it's exactly the kind of behavior worth understanding before the crowd notices. MP Materials told a quieter version of the same story. The company swung back to a profit. The chief operating officer bought stock in the open market, and the analysts held their buy rating, without feeling any need to upgrade it. And while we're on insiders, two more worth your attention. The single largest insider buy in the whole data set came from John Malone, about $107 million in one name. And in a small biotech, two specialist fund directors each bought roughly 3 times the position they already held. When people who know a business that well add to it that aggressively, it's worth a second look. Segment 3. The drift nobody is upgrading. There's a second pattern here, and it has a name. Post-earnings announcement drift. Here's the idea in plain terms. After a big earnings surprise, a stock tends to keep drifting in the direction of that surprise. For weeks, the market digests good news slowly, and the tell I look for is specific. It's a wall of analyst reaffirmations without a single upgrade, because that tells you something. It means the desks already had the stock at buy. The earnings just confirm what they already believed, and nobody has to change their mind for the stock to keep working. The clearest example I found was Rubrik. It beat, and then 17 separate analysts reaffirmed their buy ratings in the days that followed. Not one upgrade. Just 17 desks saying, yes, still a buy. Titan and Navin showed lighter versions of the same thing. And these aren't momentum trades in the chase the headline sense. These are situations where the move already has institutional permission to continue. Segment 4. What the data wouldn't tell me. Now here's the part most newsletters skip, and honestly, I think it's the part that actually earns your trust. This data is very good at one thing. It shows you where attention and capital are flowing, but it's silent on a lot of others. And there are 3 limits I'd rather name out loud than paper over. First, there are no prices in it. I can tell you what's moving and who's buying. I cannot tell you what's cheap. Valuation is a separate step, and it's the step that decides whether all this flow actually turns into a return. Second, the data is buys only. Every record is a purchase. There are no sales in it, which means I can't honestly build you a short list or a here's what's being dumped list, no matter how much you might want one. Absence of buying is not the same as selling, and I'm not going to dress one up as the other. Third, the institutional data is lumpy. A single asset manager's filing on one day in June accounts for 161 of the buys in the whole set. So when I say institutions are buying, a lot of the time that just means a name showed up in one quarterly filing, not that a crowd of funds is piling in. And one more thing on the numbers. The earnings surprise percentages can really mislead you. One company in this data printed a surprise of nearly 2,000%. Sounds incredible, right? But all that really happened is a company that was expected to lose money made a small profit instead. The swing is real. The number is theater. So I lean on the revenue surprise instead, because that one doesn't lie the same way. None of this makes the data useless. It just makes it a starting point, not an answer. And that's exactly how I treat it. Segment 5, from 1,000 tickers to a short list. So how do you turn all of that into something you can actually use? I scored the whole universe, just over 1,000 names, across 4 independent dimensions. The quality of the earnings beat, the conviction in how the analysts behaved, the weight of the institutional buying, and the seriousness of the insider purchases. And here's the key. I built it so that no company can rank high on a single signal. You have to earn your way up the list. You earn it by showing confirmation across signals that don't depend on each other. The names at the top won't all be familiar. Xometry and SanDisk led the way, both on the strength of clean, revenue-confirmed beats and real analyst engagement. And then the confluence names we already talked about. Let me give you the short list and the one-line reason each one is on it. Insperity. The chairman and CEO bought in, and an unrelated fund followed days later. That's an insider-led setup. Robinhood, a $35 million director purchase, institutions following, and analysts raising targets. All at once. That's the multi-signal one. Boston Scientific. 2 funds buying into an analyst price target cut while the buy rating held. Conviction in weakness. MP Materials. A swing back to profit, the COO buying, and a buy reaffirmed without an upgrade. The quiet beat, rubric, beat the quarter, and then 17 analysts reaffirm buy without a single upgrade. Earnings drift, Titan, a clean revenue-confirmed beat, met with broad analyst reaffirmation. Also earnings drift. And then Xometry and SanDisk at the top of the screen. Xometry with a clean beat, an upgrade, and an insider purchase altogether, and SanDisk on a large revenue-confirmed beat. And then the discipline kicks in. Because this ranking tells you where to look. It does not tell you what to buy. The real work starts where the screen ends. You pull the current price and you measure the gap to fair value. And you run each name through the compounding quartet. Free cash flow conversion, return on invested capital, margin durability, and room to reinvest. A signal tells you the market is paying attention. The quartet tells you whether the business actually deserves it. Segment 6, one quick oddity. Before I wrap, one quick oddity from the data, because I found it interesting. I went looking for clusters. Lots of buyers crowding into one name in a short window. On the institutional side, there really weren't any. No name had more than 4 distinct funds buying in a week. But on the insider side, that's where it got interesting. 2 companies had 5 different insiders, each buying within a single week. 5, and a handful of others had 3 or 4. When that many people inside a business reach for their own wallets at the same time, it doesn't prove anything on its own, but it's the kind of cluster I keep on a watch list. Segment 7, the bottom line. So let's strip it all back. What's the takeaway? The most useful thing the data told me, it told me by being stubborn. Confluence is rare. This week, it pointed at a small group of names led by insider conviction. Insperity, Robinhood, and Boston Scientific. And a cluster of earnings winners that analysts are reaffirming rather than upgrading with rubric at the front. What it did not give me was a single screaming buy or a short that the data could honestly support, and I think that restraint is the whole point. The edge in this business isn't finding a reason to act every single week. It's knowing with evidence when to wait and being honest about the difference. That's the confluence test for this week. If you want the full breakdown, the complete ranked sheet, the screen-by-screen data, and where each of these names lands against the compounding quartet, that's all in the written version, and I'll put the link in the show notes. A bit about what I do here if you're new. I'm a former Lazard and Rothschild & Company investment banker, and I bring that sell-side rigor to 2 things: deep fundamental coverage and high-conviction momentum setups. Every week, my screens pull together the same kind of data edge you heard today: analyst moves, insider and institutional flows, options activity, and growth analysis by sector. If that's useful to you, come join the Value and Momentum portfolio. Links are in the show notes, the newsletter, plus X, Seeking Alpha, Spotify, and YouTube. Last reminder, everything today was for information only, not investment advice. Do your own work, check the filings, and if you need it, talk to a licensed professional before you act. Thanks for listening. I'll see you next week.